Hi, good afternoon, everyone. Thank you for attending today's conference call. This is all about the strategy review on our quantitative space, and also we'll be touching base on PL asset management and our quant readings on the past and going forward, how we see the markets and what prospect we look at. During the call, if any one of you have a questions, please feel free to type them in a Q&A or a chat box, and our team will be more than happy to answer your queries and the questions. Going forward, the flow of the call will be that Siddharth will first take you all through how the strategy or the processes have been in case of certain changes, which as an investor and a partner you should know, and what we believe or our con parameters believes in the coming quarters, and how other aspects of investings within the quantitative space will emerge. With this, I'll just request Siddharth to take over the call because we have more than 100 plus participants on the call. So it will be great if you can just start the call, Siddharth.
Perfect.
Thank you once again, everyone.
So welcome everyone, and thank you so much for joining this call. Before we get into the details of the strategy, I thought overview of what we are making of the markets, what are we making of the macros, how is the portfolio positioning changing. I think let's spend some time there. I'll just share my screen as well. One second. Hopefully my screen is visible now. Is it?
Not yet, Siddharth. Yeah, now it is.
So I think the first thing to talk about is how India is, placed in the world markets. We are now talking from a position of resilience.
Siddharth, sorry, but we are able to see some Word file, not the presentation.
Yeah, it's a Word document only.
Okay, so what's the market outlook for Indian equities FY26?
Yes, so I've basically just collected questions from different people and just created 10 key questions that I thought were important in, talking about today. So, yeah. So we're talking about a position of resilience for India, right? In a world of trade wars and tariffs, India is very well positioned given we are the only friendly neighbor or a friendly country towards USA. So we are talking about negotiations, not retaliation. We're talking about bilateral trade agreements and not retaliatory tariffs. So I think overall, our stance is positive, friendly, and neutral. And because we're a domestic focused economy, we don't need to worry so much about how our export manufacturing businesses will shape up because bulk of India's GDP is still controlled and driven by domestic production, domestic consumption. Services to a certain extent have the export orientation. Again, services are not exposed to tariffs, but they are impacted by a slowdown in the US or Western economies. Having said that, if I shift the picture to domestic macros, right, we are still the largest and fastest growing economy in the world. We are also currently experiencing over the last 4 months consecutive slowdown in domestic inflation, which is a very good sign because it gives the RBI headroom for expanding the monetary policy. And more than this, what is important to understand is we've seen fiscal and monetary expansion. We've seen two rate cuts with 25 basis points each, so 50 basis points of rate action. We've also seen tax cuts, and we've also seen 4 rounds of liquidity infusion by the RBI to the tune of 12 lakh crores. So overall, from a liquidity perspective, India is fairly well positioned, and the domestic macro is also appearing relatively stable compared to all the other large economies. After 1.5 years of very negative currency action and rupee depreciation, we are finally seeing stability on the rupee as well. Again, our crude bills are likely to reduce because crude has corrected roughly 17-18%. FIIs, after a year of selling aggressively, have finally stopped selling and turning net buyers as of March. So both of these factors and the DXY weakening due to unfavorable outlook on the US itself So I think a combination of weaker DXY, lower crude, and FIIs, turning net buyers will support Indian currency very well in the near to medium term. So I think very important to get confidence and conviction in the relative macro setup of India for now. The other thing that is very important again is talking about valuations, right? I think 6 months back, the biggest problem for India was, rich valuations, a slowdown in growth, a mid-cycle blip. We've gone through all of that. And after the, selling and correction that we've seen, starting from October, November, December, Jan, and Feb, we finally corrected enough to create space and value in sectors in different pockets of the market. We'll deep dive on how new opportunities have emerged from a valuation perspective as well. So I think large caps trade at a 22% or discount to the 3-year average PE and a rough 14% discount to 10-year average PE. Small caps, of course, they are not cheap, but they have normalized relative to their last 5-year cycle valuations. Across the market cap spectrum, we've seen valuation froth coming off in pockets of mid and small caps, especially where valuations were excessive. Large caps were also reasonable before, and they continue to trade at a discount even now, providing a very decent risk reward from a valuation standpoint. And we are also seeing a sort of rare opportunity where valuations of large, mid, and small cap, all of them are below their 5-year median for the first time since the 2018 and the 2022 cycle. I think this is important because in the history, this has been a very decent zone in terms of risk reward. Of course, in the 2018 cycle, we saw the valuations compress even further. But in the 2022 cycle, it provided a very good entry opportunity. Having said that, right now, our domestic macro, whether from the banking and the credit side of the economy or the domestic consumption, does not seem to be as weak as it did in 2018. And therefore, we do see a stronger chance of recovery in the current cycle. 2018 cycle, of course, was plagued by a lot of financial stress in the banks, NBFC sectors, also demonetization and GST was playing out in India, and large cap and mid cap classification also was changed by SEBI. So a lot of things played out at the same time in that year, and therefore we saw valuations compress even further. In this cycle, we are quite resilient to credit quality, asset quality issues, credit growth for that matter, and our global positioning in terms of competitiveness with tariffs in the tariff as the new regime of the world. So I think this cycle can be different from the 2018 cycle, closer to the 2022 cycle, because India is still in a very, very stable space from a geopolitical perspective. From a growth and liquidity perspective, India is also very well positioned. So overall, from a valuation perspective, I don't think the valuations are dirt cheap and lucrative. But at the same time, given the state of affairs in the world, valuations are definitely not a concern anymore. So macro and valuation, two big pillars for markets to, play out positively. Both of them are now turning in favor of India. The correction that we experienced so far was also a domestic oriented correction rather than a global correction. So when India corrected, India was the only market in the world to have corrected because of the excesses built up during the 4-5 year cycle pre-correction. And now when the world is correcting, India is recovering the fastest. So we need to understand this trend. Basically, we were decoupled in the correction and we are decoupled in the recovery because we were correcting due to domestic issues. And now we are not a major part of the global contagion, which is due to the trade war. So on both sides of the trade, we were decoupled. And even in the 2018 trade war cycle, India was the only market to stay resilient and recover the fastest. And I think we're seeing a similar story play out in the recent or the current trade war situation as well, that we are the only market globally to have recovered the fastest. Another thing to understand from a more technical perspective is that this correction, while at an index level seemed like a 18-20% odd correction, the breadth of the correction was very, very sharp. And this was last seen around the 2020 and 2022 cycle, after which I think markets consolidate for a while before they start the next rally. So our breadth levels do suggest right now that we are at a very healthy zone in terms of risk reward. And usually markets tend to bottom out near these levels of breadth. Breadth simply means that on a rolling 12-month basis, how many stocks are beating Nifty, how many stocks are absolute positive. On both metrics, we are seeing a sort of convergence below 50% mark, which suggests that bulk of the market froth is already out, and now markets can create healthy entry points for long-term investors. Even when we look at the different styles playing out in the market, in the recent recovery, we saw high beta, value, and momentum play out well. Momentum recovered 6.3% in March, value recovered 10.7, and high beta also in the similar range. The idea is, are we able to rotate our factors to participate in the recovery that's now begun for the Indian markets? From July 2024 roughly till around Feb 2025 or middle of March 2025, Aqua has maintained a defensive, low volatility and quality sort of orientation. Despite that, some low volatility sectors like consumer staples, IT, and pharmaceuticals also corrected heavily because of a India-specific deallocation or an India-specific risk off. Now, as the markets recover, we need to allocate, and we are allocating more to risk on high beta cyclical sectors and concentrating the portfolio to ride the recovery that we believe is on its way. Currently, our portfolio is positioned across materials, financials, energy, metals. All of these sectors can participate very well from an economic recovery and a market recovery perspective. They've classically demonstrated to be risk-on cyclical sectors, and currently our portfolio is positioned in some of these pockets, and we are building newer areas of sectoral allocations as well, because after March, this is the first time we are getting a clearer picture of what the market is looking like in the Indian context. Feb and March were extremely choppy due to the continuous, twists and turns by President Trump, changing policies, increasing tariffs, reducing tariffs, removing tariffs, pausing tariffs, all of that. I think we do have a more clear picture now of where the world is heading and probably where India is also positioned. Other than this, another topic that we must sort of take up is what kind of return expectations should investors have. I think this is a very, very important topic, and we mined some very good data on this topic to understand how the markets have changed and how investor return expectations have changed. So if we look at the broad market, right, Nifty 500, if I look at 1 year rolling, 3 year rolling, or 5 year rolling returns, one thing is very evident. All the tall bars on a 1 year rolling period, all the tall bars are in the range of 25 to 26%. All of them are representing market returns post-COVID. And all the short bars are basically telling you what were the market returns like from 2006 till COVID. So the idea is markets have recalibrated their return expectations in the last 5 years, and there is a very high probability that return expectations must be moderated. I read some very interesting line 2 days back that returns need to be sustainable in nature rather than being stupendous. So we don't want stupendous returns, we want sustainable returns. And I think India is also going to go through this cycle of recalibrating return expectations. Just to highlight one number, say 5-year rolling returns. So even if I take data till pre-COVID peak, the 5-year rolling return for Indian markets has been in the 10 to 11% range. Post-COVID, this has changed to 19 to 26% range based on which date and which peak and trough we take. Similarly, on a 3-year rolling basis also, the long-term average is showing 11 to 10%, 10 to 11%. But post-COVID cycle, it is showing 19 to 21%. So of course, returns have stretched in the post-COVID cycle, and they will recalibrate somewhere in between the two extremes. Probably not at the lower end at 10-11%, probably not at the higher end of 20-25% plus, somewhere in the middle. And I think this sort of analysis is evident across the market cap spectrum. When we look at Nifty 50 also, we experience a similar sort of trajectory, that in the pre-COVID cycle, for a long period, right, 10 years plus cycle, returns have been, say, 12 to 14% on 1-year basis, 9 to 11 on 3-year basis, 9 to 10 on 5-year rolling basis. But post-COVID, these numbers have stretched significantly. And I think the segment which has the most pain to come from this market dislocation is small caps. I think if you look at the numbers on a 5-year rolling basis, we've seen 27 to 37% is the current expectation of investors based on the post-COVID cycle. But the long-term averages are far from that. Same story is conveyed by the 3-year rolling cycle, and the even scarier story is conveyed by the 1-year rolling cycle. So this is not to say that we'll see a sharp correction or a sharp sell-off. This is just to say that returns will come more slowly. There will be a period of time correction. The markets will be narrower, not as broad as we've seen in the last 5 years. And obviously, investors also need to understand that you cannot have 30%, 35% sort of CAGR across cycles. There will be cycles in India where we'll see high returns. There will be cycles where we will see moderate returns. And then there will be cycles where we'll see negative returns. I think currently, moderation is the direction that our models are suggesting. Before I go into the next session, Nupur bhai, do you want to take up any question?
So probably, Siddharth, if we can just touch base, I think so the investors would also be interested in knowing that current scenarios, in case if they have a liquidity, how they should look at deploying those liquidity. That's very, very important. Second thing is what they should expect in terms of Aqua as a strategy. Where are we going to be aggressive in our investment stance? Are we going to be defensive? If these two questions we take forward in terms of first fresh liquidity, and second how we look at probably what's our model suggesting in terms of asset allocations, because we have done excellently well in our multi-asset where the gold has given a very good returns. But similarly on equity side, what should be the expectation? That's I think so something that we should touch.
I'll take these two. So from an equity standpoint, I think we came out of a phase of holding a diversified portfolio because there was tremendous uncertainty in the market, right? Through Jan, Feb, and March, there was extreme uncertainty of how the markets are likely to play out. There was no sectoral persistence, there was no factor persistence. And what persistence means is no trend, no fundamental trigger, no valuation trigger persists beyond a few days in the market. Factors were rotating very fast, sectors were rotating very fast, and the VIX and volatility was extremely high. We call this a choppy market. So we dealt with choppiness using diversification to our advantage. Now, as we think there is more clarity in the markets, we are now chopping the portfolio and concentrating it in pockets where we believe the model has higher conviction. Specifically, since December, Jan, we've been overweight financials, as you guys can see in your portfolio. We've participated across HDFC, ICICI, Kotak, Federal Bank, Bajaj Finance, Muthoot Finance, the entire, lender pack. We've also had positions on the capital marketplace like asset management companies, uh, CAMS, for example, HDFC AMC, Nippon Asset Management. We are reallocating from some weaker names, say UTI and ABSL, to stronger names like Nippon and HDFC in terms of just scaling up the weights. So we are basically turning the portfolio from a diversified portfolio to a concentrated portfolio in this cycle, because now there is more clarity, there is more certainty, there's more visibility in the Indian markets. Valuations are also not through the roof, and there is some room for markets to perform well. In terms of style orientation, as I suggested, after July 24, we are finally moving out of quality low vol, moving back into value and momentum. In terms of market cap mix, I think we were 52-54% large caps and 45-46% mid and small caps, with small caps having a lower part of the allocation. I think our size allocation to large cap should be in the 40-50% range. Small cap should, increase a bit towards the 20-25% mark, and mid caps would stay also near the 20-25% mark. So it broadly could be a 50-50 portfolio between large and mid. Large cap, because valuations broadly are still very healthy, very rewarding. And as FIIs return in India, large caps should do very well as well in the recovery. And the whole, conflict where large caps were cheap for a year, but still they corrected, was not because people didn't see value. I think that was mainly driven by vulnerabilities to FII selling. Now, as mid and small caps don't have valuation in their favor, and large caps have valuation in their favor, plus FII return cut trigger, I think large cap allocation is going to be important even in this part of the market recovery. And mid and small caps, simply because they are slightly less vulnerable to any global events. Most of the mid and small caps cater to some domestic demand, and they are less vulnerable to FII selling as well in case it returns. So we need to sort of balance valuations, risk, opportunities, growth visibility across the market cap spectrum. So I think 50% will be the rough large cap allocation as we go, and roughly 50% will be the mid and small cap as well. Now, in terms of re-entering markets in this cycle, I will actually give you guys some data which suggests how we've really shaped up as a market. Just give me a second. So this is a very, very interesting signal. So this is basically telling us when the momentum factor crashes more than 20% in history and the momentum low volatility spread goes below zero, how do the ensuing 12 months play out? So usually we've seen that every time this has happened in the past, the median return for momentum factor on a 12-month forward basis has been 50%. The median return for the benchmark has been 29%, and the median alpha has been close to 24%. This is just medians. So of course, you'll have some cycles where things are much better, some cycles where things are not as good. But the probability of things playing out well from here are high, at least based on the mathematical data we are seeing. Even if you look at breadth data, we've seen that on a 12-month forward basis, markets have given a median return of roughly 40% after the breadth has collapsed as much as it did in the 2025 correction. This was again seen in 2022. This was seen in 2020. So when breadth hits the 10th or 90th percentile on either sides, we track the performance of that. And currently we are at the 10th percentile. So it is basically saying that this is a rare position to be in. and usually markets do well on a 12-month, 24-month forward basis. So people who deallocated or wanted to deallocate from equities in the correction should actually revisit their strategy to reallocate and increase allocation to equity during such extreme, turns in the market. And we also need to understand, I think we got a lot of questions on, going into cash and managing cash. Our models have given us a very clear signal through this entire cycle that this correction was a domestic correction only. This was not a global contagion, the way we look at data. What this means is there are two types of corrections. One is India is correcting not because of domestic or India specific issues. India is correcting because of global issues like 2008 or 2020. We've seen this play out in other cycles as well. But broadly, when the effect is due to global problems, the corrections tend to be sharper, deeper, and tend to last longer. That is what historic cycle data suggests. When corrections are due to India-specific issues, the corrections are not as deep. They are sub 20% most of the times. They last for a shorter time frame, and the recovery is also much faster. And we only go on cash when we believe that there is a global systemic asset class risk. I've used these words time and again through the last 2 years, that only when there is a global macro systemic asset class risk to equities as an asset class is when we go out of equity and into cash. The current cycle did not play out like that. It was an India specific issue. And because we were not in cash, we were able to recover by 7% in March. Had we gone into cash and saved some drawdown, we would have also not been able to participate in the recovery rally. And the recovery was swift, fast, and extremely tough to time. So we stayed the course, we took the drawdown, we participated back in the recovery. And now, as there is more direction, more clarity on what India is looking like, what sectors are looking like, we are realigning and rebalancing our portfolio, as you guys must be observing, to stay aligned with the new market regime. So far, there have been only 3 major regime changes in Aqua. The first 12 months, June 23 to June or July 24, it was one regime which we classify as the risk on regime, a value momentum regime, or a bull market regime. July to December, markets were in a sideways or consolidation phase. We were also quality and low volatility oriented. We also corrected in line with markets to the tune of 1.5%. But in the bull market, we were up 77% versus BSE 500 at 36 and Nifty 50 at 25. So we were 3x and 2x in the bull market phase, in line in the sideways. We got caught off guard in January, which has been the worst month in the history of Aqua. We got caught off guard. Despite a quality and low vol stance, our portfolio corrected around 10-11%, as opposed to benchmark at around 5%. So that month was a costly month for us, but we are making it up by realigning and repositioning the portfolio now. So I was talking about the 3 distinct regimes. So the first regime, risk on value momentum bull market, then is the sideways and bear market, which was till March, from July 24 till March 25. That was the second phase, which we call a risk transition and a risk off zone. And now we are entering the third zone, which we classify as the risk recovery zone, where we believe the markets should do well. Despite global challenges, Indian markets should do well because we are pretty much a safe haven from emerging market standpoint and developed market standpoint. Whether I look at growth, geopolitical stability, or China getting out of the whole capital and growth race for some time. So we are very, very well positioned here. And having said that, I believe investors who want to allocate to Indian equities, this is a good time to allocate to Indian equities. And another concern that most investors might have, that how will we recover alpha? we will recover alpha in the same way that we made alpha in the first place. We made alpha when the markets were healthy. Our portfolio was positioned in line with the markets. We maintained a higher portfolio beta, and our portfolio was concentrated between 25 to 30 stocks in selected themes where the models had high conviction. So I think after, now that this whole risk transition phase seems to be coming near an end, our portfolios will turn aggressive and our portfolio's beta will increase. And you will also see the sector concentration that we are likely to play out in the future. And again, very important data here. Most of the times when India specific corrections happen, they've been mild to moderate. So 52 and 47% of the times, India specific corrections have been mild to moderate, but global corrections have been severe for a majority of times. So it's very, very important to understand that this correction that we are coming out of was not a global correction and rather an India specific correction. I'll take another couple of questions. Nupur, is there any more questions that you want to specifically
So
prioritize?
there are a few questions, obviously, which everybody has in mind, right? Currently, gold versus equity, because that's the two parallel asset classes, which after correction, equity has definitely come up, but gold has been among the best performing asset class, and we have just seen the tweet of Uday Kota coming few days back, which has made it more interesting. So I think that's a question we should take, Siddharth, because on our multi-asset, we had an exposure to gold and how that has navigated the market.
So our multi-asset strategy has done extremely well in this entire phase. We've been beating the benchmark as well. And we managed risk also very well in the correction and the recovery. We participated very well. Gold has been 30%, 25 to 30% of our portfolio for the last 12 plus months. So that position has played out beautifully for us. Equities have also recovered very well. Within equities, we had large caps to the tune of 30-35%, mid and small caps to the tune of 40%. So our equity positions have also recovered very well. And, multi-asset invests in asset classes purely using ETFs. And this phenomena actually played out the best in this cycle. So market breadth, as I told you, was down to 80% of the stocks were down more than 20% in the whole Jan-Feb cycle. But index was not reflecting such a bad state. So in Jan, Nifty was down only 3.5%, but stocks were down 20-25%. So on the way down, the multi-assets allocation and ETF approach helped, prevent downside. And on the recovery also, the indexes have recovered very sharply and gold has recovered. So overall, from a risk and return perspective, the multi-asset strategy has proved very robust and very resilient in times of turmoil. And in terms of our view on gold, I think gold is, having a lot of triggers in favor of it and few sentimental triggers which are against it. And let's just sort of review this position. DXY coming down is a straightaway mathematical benefit to gold because gold is globally priced in dollars. So when dollar weakens, you need more dollars to buy gold and therefore gold prices go up. In times of economic or geopolitical uncertainty, gold does well as a safe haven asset. In an inflationary global environment, again, gold does well as an inflation hedge. When cryptocurrencies have a risk-off sentiment, gold does well because it's a classic risk-off asset. When bond yields are rising, that is a negative trigger for gold. And I think right now, that is probably the only negative trigger for gold, that bond yields can stay relatively higher in a world of economic uncertainty and higher inflation. Having said that, central bank buying action across the world, de-dollarization across the world, these are long-term structural triggers for gold. All of this is painting a very positive picture of gold, and which is why we had gold in the portfolio for 12, 13 months, and that to not 2-3% allocation, but 30% odd allocation. Now, the only risk at this point is that when a trade is discovered by everyone, it tends to become a crowded trade, and therefore you can either see some profit booking, or you can see people allocating smart money moving out of gold and moving into other riskier assets. So these are probabilities, but again, it's too early to take a anti call on gold. We probably still need to wait for more evidence before we move out of gold and move into a pure equity position. Yeah. Next question.
We can also talk about something on tariff because a lot of people have uncertainty about US tariff and the sectors and how our quant models are currently suggesting in terms of the sectoral allocation and how we look at the building of the portfolio around that.
Okay, so I think everyone in the world is as uncertain about tariffs as you are and as I am also. But prudence suggests that the portfolio should have a healthy mix of domestic focus sectors, which have got zero dependence on tariffs as such. And it should also have a small allocation to some global place if the tariff situation plays out in favor of India. The way we see it is we don't need to have zero tariffs on India to do well in the tariff world. If tariffs are the new normal, then I just need to be better than my neighbor. I just need to be cheaper than all the countries I'm competing with. And in the current situation, the real, impacted or the real victim of the tariff war or trade war is going to be US and China. And India is going to be more of a spectator to this global trade war rather than the victim of the trade war. So, in the current situation, I believe having a higher allocation to domestic sectors like financials, materials, consumer discretionary, energy, power, this will be one part of the portfolio. And then a small exposure to global plays, such as, say, IT, such as metals, such as chemicals, will be a smaller part of the portfolio. That is only as a tail event. If things play out well, then we should be able to capture some alpha on the upside in some of these plays. So I think it should be a 70-30 sort of portfolio where 70% will be domestic focused, 30% will be global facing. And within global facing also, those pockets where we could have some advantage. In IT, there are no tariffs, so the play is on global recovery. In metals, we are much better off than China, so we have a relative advantage. In chemicals, we are much better off than China, so we have a relative advantage. So even in the global plays, you need plays where you have a relative advantage to recover or do better than the competing country.
I think it's the market has been extremely volatile in last 6 months or so, and it has moved to the extreme pendulums. A lot of people are interested in understanding that how we will be navigating this volatility, and at the same time, in case if we have something more on a stock specific or a trigger based rebalance or some data around that, that will be also very helpful.
Sure. So I think bulk of the market volatility was stemming from a point of rich valuations, slowdown in growth, and aggressive FIs selling. I've just pulled up these numbers here. So FIs have sold roughly 3.2 lakh crores between October to February. Now that's tremendously aggressive. markets should ideally stabilize and bottom out, not when FIIs start buying. Even if they stop selling, markets will automatically bottom out. And we believe that phenomena is already playing out live in front of us, right? They closed March as net buyers. So I think that is very good evidence of volatility also reducing and India becoming a preferred spot for foreigners once again after 1 year of selling. I think 3 days back, I was reading some very large global funds talking about their global positioning, where they are deallocating to China, deallocating to US, deallocating to Germany, deallocating to Japan, and increasing allocations to India without taking names. The point is, global fund managers are also looking at India very, very constructively from this point on. And I think the reason, as we discussed, right, DXY is down 11%, crude is down 17%. The currency is also likely to strengthen. So, overall, from a macro perspective, India looks very interesting. And from a factor perspective, also India looks extremely well positioned. This is a very, very rare signal where all the risk on to risk off factor spreads are near zero. And this is extremely rare, even on a 20-year cycle and even in the last 5 years. So, what this means is the value to quality spread is near zero. The momentum low volatility spread is near zero, and the small to large spread is near zero. Just to explain you what this spread means, when I'm looking at the 12-month returns of value as a strategy and comparing that to the 12-month return of quality as a strategy, it suggests that value has underperformed quality. So value is a riskier style of investing. Quality is a safer style of investing. Momentum is a riskier style of investing. Low volatility is a safer style of investing. Same with small and large cap. So basically, all the high risk investing styles have underperformed the low risk investing style by a very large margin, to an extent where the spreads between them are now at zero on a 1 year rolling basis. And this suggests that markets are well positioned for a sustained recovery. And recovery does not mean 1 month, 10%. It could also mean 12 months and a sustained recovery, because all the factor positioning suggests that bulk of the pessimism already is in the price. And this is what creates ground for a recovering market. Even from a global perspective, if you look at India, very, very evident that in March, India was the only market to have staged a sharp recovery at 6.5%. All other global markets, S&P, NASDAQ, UK, Germany, Taiwan, Shanghai, Hong Kong, everybody has demonstrated weakness. India has demonstrated strength. This is what I was talking about, decoupling in the recovery. And now we also need to understand what happened 12 months before, where we were the weakest market. Global markets did well, India didn't do well, and therefore there is a major regime shift in the post-trade war era. And we need to rebalance and reallocate the portfolio to accommodate for this shift in regimes. And finally, from a sectoral perspective, our quant model suggests that staying invested in cyclical sectors, staying invested and increasing allocation to high beta sectors is the way to go, rather than staying invested in low beta or anti-cyclical sectors. And our portfolios also reflect over the last 3 months, gradually we've reduced weight to non-cyclicals and built up weight in cyclicals. And we believe the time has come to position the portfolio for a recovery phase of the market rally. And I think bulk of April has, gone in realigning and adjusting the portfolio to the new regime. We're selling some old stocks, moving out of some sectors which we believe are not relevant anymore based on quant models, reallocating to sectors and stocks which we believe are relevant in the next 12 months, in the next 4 months. And finally, we've also introduced, a dynamic periodic rebalancing system which will work on major triggers in the market rather than every month, every 2 months that we were following earlier. And this should help us stay more agile when needed and stay or reduce churn when needed. So if the cycle demands more agility, we should be able to demonstrate more agility. If the cycle demands us sticking it out, we will be able to stick it out. We are going to use changes in style regime as a major trigger. We are going to use changes in sector regime as a major trigger, and we are going to use changes in size regimes as a major trigger to rebalance. So having said that, the trigger based rebalance should give us more flexibility when needed, more agility when needed, and more pause when needed.
I believe, Siddharth, there are no further questions, and we have covered most of the questions or the queries that investors do have. With the closing remark, if you would like to add something, or we can thank the investors and close the call.
So, I think what I would like to say is that based on how our portfolio is positioned, based on some big winners we've picked in the last 3 months, even in challenging markets, right? We've got Kotak, HDFC Bank, Bajaj Finance, Chola, Chambal Fertilizers, and many more names which have done very well in a very choppy market. And these were all new ideas in Aqua. These were not legacy ideas that we've been carrying forward. Whether we talk about some cement stocks we've picked up, whether we talk about the ability to stay invested in IT as a potential tail play, all of that has demonstrated that Aqua's resilience has increased in the last phase of the market. And we've also not been churning stocks as frequently as we used to before. We've held stocks and we've concentrated them. And now, as market direction becomes more clear, the portfolio will even narrow down from the current slightly more diversified portfolio to a slightly more concentrated portfolio. Great time, to look for down days, increase allocation, play the recovery. We've borne the brunt of the correction. Would advise and sincerely request investors to stay the course so that they can participate in the recovery. Emotions usually, will force people to take decisions that don't let you enjoy the rally or the recovery that comes after a very sharp correction. And I think right now, bulk of the pain is behind us. We've gone through the tough phase together. Stay the course, stay invested so you can actually participate in the recovery as well. Prudence suggests staying invested for a 3 to 5 year cycle, but 3 bad months and everything changes. Let's not let that happen and let's stay invested for the actual course of the strategy to play out. Nupur Bhai, would you like to add something?
So, see what Siddharth said, and I would like to add to that is that when you come to an equity as an asset class, volatility is an inherent characteristics of equity as an asset class. Sometimes the volatility is because of the global uncertainties, sometimes it is because of the domestic uncertainties. Having said that, and our data also proves that the investors, those who have stayed invested, and more so the investors, those who have added during the tough time or the rough patch of the market, have been benefited in a real long term. So the whole idea is that the Aqua as a strategy has demonstrated the capabilities of generating a superior return in first, will be now completing close to around 24 months. First 12 months was excellent, exceedingly well. There was uncertainties in the market. We also invest into the market. So you need to see some volatility in the portfolios and the returns as well. But as markets have recovered, we have also started coming back on the track and doing far better than the benchmark and better than the indices. That's the whole thing to sum up, but we'll definitely looking forward. In case if you guys have any questions, you can connect with one-on-one with us. Or you can just call up Siddharth and me or write an email, and we'll be more than happy to answer your queries and the questions. With this, thank you everyone for attending today's call. And we're looking for a long-term association with every one of you. Thank you.
Thank you, guys.